Hey everyone, we are going to finish up chapter 14 today. I didn't do this through a Zoom presentation. I figured I'd do this right on our PowerPoint, and that would be the easiest way to finish off talking about 14, which is on money and our banking and financial institutions in the United States. So just a quick review. Remember, the functions of money are they are a medium of exchange. We use those things, it's a acceptable form to use to buy and sell goods, so we're not in a barter system. It's a unit of accounts. We could value goods in terms of dollars, and it's a store of future value, so we could hold it for future items. And money is very liquid, meaning money by definition in the United States is currency, bills and coins, and checkable deposits. We talked about institutions that offer checkable deposits, money on deposit that's available to have checks written off of it, or EFT payments, electronic funds. Commercial banks, we talked about the top 10, savings and loans and what they do, mutual savings funds and credit unions. The M2 definition involves a special kind of accounts such as money market demand accounts or deposit accounts, CDs, and money market mutual funds. So they are also included in our money definition, but the M2, they're very liquid items, or I should say the M1 definition of liquid cash items plus near monies, or items that can be converted to cash very, very quickly. So in the big scheme of things, here is our M1 is about a quarter of our money. And then we have savings deposits, money market deposits are about 66%, money market mutual funds are 6%, and time deposits about 3%. So what backs money? Because we talked about there's no more gold backing money. Well, it's guaranteed by the government's ability to keep the value stable. Money is actually debt. A dollar bill, or a coin is debt. Why is it valuable? It has no intrinsic value, or I should say, the intrinsic value. The item itself has no value. Paper, metal, but it's acceptable. It is looked at as legal tender, so that's what makes it acceptable. And it's relatively scarce. Now, that's what we looked at the other day. Prices, what's important to remember is prices affect purchasing power of money, the value of money. Remember, back in 1977, I could buy 2 loaves of bread for $1. Now I can't even buy 1 loaf of bread. What we have to be careful of is hyperinflation, or rapidly rising prices that essentially make money irrelevant, unacceptable, no value. So it's very important that we stabilize money's purchasing power, and we need to have monetary policy and appropriate fiscal policy to do that. So how do we do that in the United States? We have the Federal Reserve System. So the Federal Reserve System was created from the Act of 1913. The Federal Reserve Act of 1913, where back in the early 20th century, the government saw a real need to stabilize, keep our money stable, even though it was still behind a gold standard, and have stability within our banking system. So that's what the Federal Reserve Act was to accomplish. And what it does, it set up a board of governors of the Federal Reserve System. Now, they have their own website right now. There should be seven board of governors. There's 2 vacant positions, so there's only 5. And the U.S. president appoints the 7 board members. And of course, it's also there needs to be a confirmation of the Senate. So it's not a solo appointment. So it's not a political appointment, or it shouldn't be. Their terms are 14 years, and they stagger so that one member is replaced every 2 years. Okay, so as I said, right now there's 2 vacant positions. There's 5 active members of the Board of Governors. Now, what do they do? Well, let's keep going before we talk about what they do. There are 12 reserve banks set up by this law, and they are considered the central bank or banker's bank. So individuals are not going to a Federal Reserve Bank to do banking work. They are the wholesaler of the banking system. They're the middleman, the person behind the scenes of the regular commercial banks or thrift banks. And they're broken up into geographical area. So they primarily are loaning money, being involved on the back end of the banking system. So the Board of Governors, 7 members, oversee the 12 Federal Reserve Banks. There's also a Federal Open Market Committee. They're advisors to the Board of Governors and the Federal Reserves. The Federal Reserve Banks are the backbone for commercial banks and thrift institutions, who are the providers to the ultimate consumers, the public, which are households and businesses. So that's a great flow chart to show you how the Federal Reserve banking system works. These are the various Federal Reserve banks currently in our country. There's 12 districts. And if you're looking going, why is there only one out west? Well, think about when this law was created. It was still the early 1900s, and the development of the West was still in its infancy. So that's why you're only seeing one out there right now, and the majority of them are in the center to the northeast part of the country. So the Federal Open Market Committee we saw, and you could refer back to page 296. Remember, they're the aides. They aid the Board of Governors in setting monetary policy. Well, who are these people? Well, they are the 7-member Board of Governors, the president of the New York Federal Reserve Bank, and then the other 4 members are the remaining presidents of Federal Reserve Bank on a 1-year rotation. So every president of a Federal Reserve Bank gets to participate in this once every couple of years. They meet to determine the purchases and sales of government securities in the open market. So they are there helping to assist in monetary policies of the Federal Reserve Bank. So that's their job. The other components of the Federal Reserve System we talked about already, commercial banks and thrifts. There are over 6,000 commercial banks. 3/4 of them are state registered banks. So these are private charters by the states. It's basically corporations. And then 1/4 of them are private chartered by the federal government to operate on a national level. So there's state and national. There's 8,500 thrifts. Remember what we talked about what thrifts are. Savings and loans, credit unions, and they're mostly in the credit union area. Okay, and they are overseen by the National Credit Union Administration. All of these commercial banks and thrifts, this is important, must keep a certain percentage of checkable deposits on reserves. So that means they have to keep that money in their bank. They can't loan it out. Remember what our banking system is about and what our video said the other day. People put deposits and businesses put deposits into these banks. The banks take that money and loan it out. Well, what this is saying is a certain percentage of those deposits that are brought in must be kept there and not loaned out. So these are the world's 12 largest financial institutions. The other day we looked at the America's 10 largest commercial. So some of them are present here. Some of them aren't from our list we looked at the other day. But there's their assets in trillions. Pretty interesting. And that's in dollars. So we can compare apples to apples here. But Bank of America is on here, JP Morgan Chase. I'm not sure. I don't think Barclays. No, they're a UK company. So Citigroup, Wells Fargo. So we have a couple of them, right? Now that we know the different components of the Federal Reserve, what is it supposed to do? Well, the first thing is it issues currency. Remember, it doesn't make it. That's the Department of Treasury who makes currency, either in the mint or the printing and engraving area. But they issue it. They're the ones who put it into the market, into the banking system, or take it out. And if you are ever interested in knowing who issued a particular dollar you may have, they actually identify that in the upper left-hand corner of the bill. So take a look at some money you may have and see if you could find that. They set and hold reserves. That controls the money in the banking system and the financial system. So if they want less money being loaned out, being in circulation, they'll raise the reserve requirements of those commercial banks and thrifts. How much money do we have to keep in the bank? If they want more money in the banking system, they'll lower those reserves. They lend money to banks, and they're considered the emergency lender. We're going to talk more about that when we talk about that financial crisis that occurred during 2007 to 2009. That led to the Great Recession, right? So they lend to financial institutions, usually on a short-term basis, to banks and thrifts, and charge them interest at a discount rate. Now, one thing to remember is the Federal Reserve and the federal banks are not here to make a profit. Okay, so they're not competing with our banking system. They're kind of like the parent, trying to help them out, setting the rules to control how money is affecting the economy. Okay, so as I said, they're not there to make a profit. They're the banker's bank. The bank goes to them to borrow money if they need it, and they'll be an emergency lender if they need to. They're not competing. The Federal Reserve is there for monetary policy. They collect checks, and what's really cool about the Federal Reserve is instead of them, taking the checks that were written on a bank and saying, okay, Bank A, you need to now write a check to Bank B, they kind of do it behind the scenes. They just allocate the money to the different banks so that any bank that had a check written on it, the money is deducted, and any check that should have a bank that should have a deposit because of that check is deposited. But it's all done electronically, computer-wise. They act as a fiscal agent for the U.S. government. They provide the U.S. government with financial services that may be needed. They supervise the operations of banks and are involved in audits, making sure the bank is functioning. These different banks are functioning properly. And of course, we said control the money supply. They regulate that amount of money and the interest rate. So they have some very significant functions with monitoring and managing our monetary system in the United States. As I said, the Federal Reserve Board is appointed by the government or the president and has to be okayed by the Senate, affirmed or confirmed by the Senate. So there is independence from the government to isolate them from political pressures as much as possible. Okay, so they play a very, very important function. And that's what I was just talking about there. And enables the Fed, the Federal Reserve Board, the Federal Reserve, the Fed, to take action to increase interest rates in order to stem inflation as needed. So they'll raise interest rates or lower them to control inflation. Okay, so that is the backbone of our monetary system in the United States. M1 money, M2, who makes the money, and who's actually creating monetary policy, because we don't have that backing of the gold reserve anymore. Now we're going to change our focus to the financial crisis of 2007 and 2008 and like the before and after. What happened? What changed with our monetary system because of this crisis? Now, we've talked about this a little bit already in class about how due to essentially banks giving out mortgages, loans to credit risky people, and loaning more money than the house was actually worth because of a housing bubble, that when the housing bubble burst and home values started to decline, people could not pay their mortgages and they could not sell them enough money to cover the mortgages. So that's the kind of the general story. So the government encouraged this type of home ownership. They wanted people to stop renting. And because of that, they encouraged the subprime loans, which is loans to high-risk debtors. Then once the bubble of the housing market burst and real estate started declining in value, it created loans being defaulted on. Well, what's the big deal about that? Well, here's what happened. Banks were taking these subprime loans, which were very risky, and they were packaging them up and selling them as bonds in a market. Now, what is a bond? A bond is a loan. So when you sell a bond, you're borrowing money, essentially, okay? And the person that holds the bond, that purchased the bond, will receive interest payments over the life of the bond, and then finally, the principal. So what these banks did was they packaged up all these mortgages and sold them to investment companies, who then sold them as bonds. Which you think, well, what's the big deal to the banks? Because they're out of the picture. But then the banks went and loaned money to these investment companies that were selling these risky bonds. So when the people who owned the mortgages in this bond stopped paying, the mortgage companies stopped getting money, the banks stopped getting money. So really, they didn't alleviate their risk by doing this securitization. So securitization is the process of slicing up and bundling groups of loans into new securities being bonds. So as I said, one more time, because it's kind of weird if you're not familiar with these things. The banks took the loans that they made to high-risk people, they packaged them all up and sold them to investment companies. The investment company made it into a bond, sold it to a bondholder, and said, okay, as we receive the money from these people that are packaged up in your bond, we're going to pay you interest, and then at the end, we're going to pay you all your money back that you gave us to buy the bond. Well, the people in the loans started defaulting. So the investment company couldn't pay interest or the principal back to the bondholders. But what's worse is, okay, they borrowed money. These investment companies borrowed money from the banks that sold them these loans, and they couldn't pay back the banks. So the whole system started collapsing. And what we say, people were underwater. Homeowners abandoned homes and mortgages. I can tell you from personal experience, I bought a home that was underwater. That doesn't mean there was water all over the place. Here's what happened. It was 2013. 2011 is when stuff really started changing. But the person who owned my home bought it during this crisis, bought it when the value of the home was in a bubble. So they were able to borrow a lot of money against this home. So this isn't real information here, but let's say they bought this home for $220,000 and they borrowed $200,000 on it. When it was really inflated due to this bubble, this inflated price of real estate, well, real estate started decreasing in value. And let's say when it evened out, it came down to its normal price of about $185,000. That's really what the homeowner should have bought it at. But because the price was inflated, they bought it and took a mortgage for $200,000. So they owe $200,000, but they can only sell it for $185,000. That's what we mean by underwater. You owe more than you can sell it for. So instead of selling it and trying to get out from under it and paying off that extra $15,000, what a lot of homeowners did was just say the hell with it, and they ran away from it. They said, let the bank take the home, and we just lost whatever we put into it. Unfortunately, that's what a lot of people were doing. So some of the banks were coming back and saying, I know in my case, they said, try to sell it for the mortgage. And I know I was trying to buy my home for less than I actually wanted to, but the guy came back and he said, I can't. I don't have the money to make up. The bank won't let me. So I was still getting a good deal, so I bought it. But that's what was happening during that time. And I bought my home in 2013. So we were still having the effects of this housing crisis and financial crisis in 2013 locally. So there were a lot of failures and near failures of financial firms because of this disastrous securitization that took place and the way the money was funneling through. If the banks wouldn't have loaned the investment companies money, I don't think the impact would have been as great. But because the banks were loaning the investment companies money, they were also on the hook. So not only were the investment companies failing, but so also were the banks, and it was becoming a domino effect. And they talk about the various companies that were at failure or near failure. Merrill Lynch had to be bought out in a fire sale, so that means basically pennies on the dollar. It was not sold for its true value by Bank of America. Lehman Brothers declared bankruptcy. Goldman Sachs, Morgan Stanley, and other financial firms had a lot of exposure to these securities, and they became what's called bank holding companies, so they could qualify for emergency loans from the Federal Reserve. They were trying to change their company form so that they could survive. So it was just a bad time. AIG suffered enormous losses. AIG is an insurance company that overexposed itself through insuring these mortgages. It was just a lot of different facets of our financial system were just being affected by these crises. So in response, the Troubled Asset Relief Program, or you'll hear it referred to as TARP, was passed by Congress. It allocated $700 billion for emergency loans to stabilize our financial institutions. So it was a bailout. Now, what's sad is, and what the problem here is that companies took on too much risk, too much, and that's what caused these failures ultimately. So how do we react to this? What did government do to say, hey, we can't let this happen again? As your book said, it was an exercise in moral hazard. Investors and financial services firms took on too great a risk because they felt that they were insured by companies like AIG against losses, but it wasn't enough. And then when the bottom fell out, companies like AIG couldn't pay the insurance to save them. So, troubled asset relief. Okay, that was our troubled asset relief program. Sorry. The post-crisis, then we have what's called the Wall Street Reform Consumer Protection Act, and that was put in place because the banks, the investment companies who were investing in these and buying these loans, and the insurance industries were all becoming one company. They were constricting into one company. So if one segment failed, the whole company would fail. And that's what really put this financial services into disarray. So in 2010, they came out with this law, basically. And what did it do? It changed our financial services. Now we're broken into major categories. So there's no longer this constriction of the industry into one company. There's commercial banks, and you're a commercial bank if, this is on page 303, state and national banks provide checking and savings account, sell certificates of deposits, and make loans. You're a thrift, savings and loans, mutual savings banks, and credit unions. So you're defined, and you have to stay within that definition. An insurance company. They're only firms that offer policies, mutual fund companies, pension funds, securities firms, and investment firms. So as indicated on page 302, it eliminated the Office of Thrift Supervision and gave broader authority to the Federal Reserve to regulate large financial institutions so that this constriction wouldn't occur in the future. It created a Financial Stability Oversight Council to be on the lookout for risks in the financial system that wasn't there before this crisis. It established a process for the government to liquidate assets of failing non-bank institutions. It provides regulatory oversight of mortgage-backed securities, the things that caused this disaster, and required that they're traded on a public exchange. So they want to be aware of them, and they want reports about them. They've got to regulate them. Require companies selling asset-backed securities to retain a portion of the securities so the sellers share a part of the risk. So they're not allowing you. So these mortgages, you can't just sell off all your mortgages. To a bank, a mortgage is an asset. And you can't just sell them all off. You have to retain a portion. Establish a stronger consumer financial protection role for the Fed through a new Bureau of Consumer Financial Protection. So why weren't these things there before? Because they weren't needed at that point. But as new securities come out, new inventive ways of making a company larger or merging it, okay, or not paying attention to risks and how risky things are, they could cause disasters like we had with this financial crisis. So this sent those that were for this law, because there's many people that are for and against it, the thing is that they're saying this sent a strong message to everybody who was involved with that crisis. You're not going to do that anymore. Against it, the people against this new law said, no, the regulators had these tools before. They just didn't use them. It's the government's fault also because they promoted these kind of loans to even be made in the first place. And you hear that a lot. And it's going to cost more money for these new laws and regulations that are being imposed on financial services. So Is it good or bad? I guess we're yet to see, but those are some of the arguments for and against it. Okay, so this chapter, again, we focused on our monetary system, banking and financial institutions, how they're managed, the Federal Reserve's role in our financial policies, and how we handled a very bad monetary crisis, financial crisis of 2007 to 2008, and where we are law-wise with the response to that. So that's it for our chapter 14. I think I'm just a couple more things. There's our major categories of financial institutions now. The Wall Street Reform and Consumer Protection Act that we talked about. And we talked about increased moral hazard, what that was. And during the financial crisis, the Fed had to act as a lender of last resort to keep banks and other institutions solvent so that they did not file bankruptcy. Okay, so that is the end of chapter 14. So on Tuesday, I plan to talk about chapter 16, where chapter 16 goes into talking about interest rates and monetary policy. So how do we create monetary policy, and how is interest rates involved in that process? So I thank you for listening. Please let me know if you have any questions on the material, and I need you to finish everything as of the current due dates. Have a happy Easter.